What is driving the market narrative in general right now? I mean, you've got earnings, you have that Fed situation yesterday, which was seen as a bit more dovish than I think expected, and then you've got all these trade headlines.
Yeah. Over the very short term, of course, we have a few headwinds because of this, but I think the real underlying narrative of the market is growth is going to continue, no recession around the corner, and the market's growth expectations are too low. That gives an upside bias to stocks.
Do you think the softening, the slowing we've seen in the economy, do you think that's bottoming, at least here in the U.S.?
I do think we're probably coming to a bottom. The GM strike is over. I think manufacturing is starting to stabilize. That's what we're hearing at Fifth Third from our middle market customers. That's all good news. What isn't going to change is we're not going back to robust growth. We just don't have the workforce to do that.
Omar, I realize that stocks are taking a breather here today, but the S&P closed at another record high yesterday. Where does it go from here through the end of the year?
Well, I think it's going to be more volatile. It has to be. You know, after you hit a record, normally you actually see investors taking a little bit of a pause. As we go through the end of the year, you have the fiscal year's ending. You have a lot of things going on through the end of the year. I think, you know, after the Fed decision yesterday, a lot of people will be looking at what is the hard data tells us about the state of manufacturing. What about the wage growth and the potential reads on inflation, because will lead into future Fed decisions.
In terms of investment strategy right now, what would you be telling clients or investors out there right now to be focusing on or buying?
For us, it's a rare period for us during this bull market. It's one of the very few times we have not been overweight our benchmarks and stocks. We're neutral. That's not a bearish call. That's just a recognition of a slower growth environment. What we did do, and this is only the third time in the last 10 years, we've added gold to portfolios.
Interesting.
And we just think, given the constraints because of the labor force, given the fact that we don't see a rebound in CapEx that will drive productivity, that means we have a very narrow window of acceptable growth. It's too easy for something to go wrong. Gold, in this case, is an insurance policy.
So what's a good percent allocation of the total?
We're just stepped our toes in the water with a 2%. We envision that going higher as we move later in the cycle, but we wanted to get started.
If you think industrial activity is bottoming here for the reasons you cited, can the Fed pause reasonably? Is that a good strategy now?
I think that is a good strategy. We actually fear that they've used up some ammunition. Yep. The Fed likes to talk like it's 1995 and they can add 5 years to the cycle. We think it's much more like the mini easing cycle of 1966. 3 rate cuts that started when the unemployment rate was 3.6%. You only got 3 more years out of the cycle. I think that's about baked in already here at most. And you took the unemployment rate only from 3.6 to 3.4. You didn't do a heck of a lot of good.
Omar, what was your takeaway from the Fed and Chair Powell's comments yesterday?
Well, I think the Fed is finally realizing that the data is not there to support further cuts. And I think a lot of what we have done in the previous 3 cuts it's been more related to what is happening internationally, less about what the U.S. economy. I think we all agree that the U.S. economy seems to be decelerating. That's its normal part of the cycle, but it's actually at the trend level that you would expect. We should expect that trend to continue as we go into this global deceleration. And I think the Fed realizes that the drivers of the U.S. economy are in a pretty good shape. When you think about unemployment, you think about housing. When you think about consumer, in particularly consumer, everything points out to something that is just about in the range of trend that you would expect for this part of the cycle. So the Fed is just coming to the realization that with this, they feel comfortable that the international markets are not going to bring the deflation that they are all fear. So the mandates for them seem to be in good shape. Stability of financial markets, unemployment and inflation, all of them seem to be in the right place for the moment. So pausing seems to be like the most natural decision they could come up with. And the market seems to agree too.
So Omar, in light of that, what do you like in the markets right now? Where would you be putting money to work?
Well, I think when you actually think about where we are, we're in a very interesting inflection point because while we continue to see this deceleration, I think expectation of growth are way too low. We also see, on the other hand, that earnings expectations are also way too low and that the potential for an acceleration of earnings growth next year seems to be in much better place. So what we have observed and some of the things that we're starting to look at is the potential for a rotation away from the expensive defensive sectors and into more of the cyclicals and the higher quality, and value starts to seem to be taking a little more traction after a couple of years of being severe underperforming. The attractive valuations seems to be something that people should be paying attention.
Hey, Jeff, just to wrap up here, in answer to why you have this new allocation of gold, I think you said it's too easy for something to go wrong.
Correct.
So what in your mind is sort of something that might go wrong?
Well, it could go either way. Some kind of spiral in trade problems around the world. We have all these populist movements that are essentially anti-globalism, which can translate into anti-trade. If you send our base growth rate is sub 2% already, you send it down to sub 1%, you start to get credit concerns and credit breakdowns, and you spiral into recession. On the flip side, perhaps this is a replay again of that 1966, where you put a little too much money into the system, and you went in the 60s from a period of sub 2% inflation, the whole decade, sound familiar, and suddenly you went above 2.5% and never turned back until the mid-1980s. I don't think
you're
we're
not calling for a repeat of 70s.
No, absolutely not. But that doesn't mean you can't get to 3% inflation. We do have rising wages, albeit slowly, in the United States. There is a continued workforce shortage in the United States. And we're going to lose the productivity gains because we're losing CapEx that have been offsetting those.